Hello, everybody. My name is Bennett Tchaikovsky, and welcome to Intermediate Accounting, Income Taxes. And this is going to be our introduction to income taxes, as well as we're going to talk a little bit about permanent differences. So right over here, my disclaimer and copyright notice is that the information and opinions in this presentation are those of myself and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2026 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Throughout the presentation, I will make reference to publicly available information that is the copyright of other parties. I do not claim any right to the copyright that I'm referencing to those third parties. So let's go ahead and kind of jump into this. So income taxes, just in general, we've got essentially, obviously, we have to follow GAAP when we're making financial statements. And if we don't follow GAAP, bad things happen. And the reason why we do follow GAAP is because of comparability and consistency, as well as many other things. But if we use tax rules to build financial statements, I don't know what would happen. I'm not sure if that would be Carmageddon or some kind of Armageddon. I'd be calling Professor Stephen Grinberg probably every couple days to ask him, like, hey, how do I do this? I'm sure Steve would be happy to answer me, but he would probably get tired of my calls soon enough. But we're going to go through and use GAAP to compute income tax expense. You're going to see it on the income statement, and you're also going to see a lot of disclosures relating to income taxes throughout the financial statements. Also over here, but for the Internal Revenue Services, obviously they want to encourage certain types of behaviors, like, for example, allowing you to deduct equipment immediately upon purchase. So when you see this, we're going to have differences between book income and taxable income. And the way we're going to classify these are going to be, are these permanent differences or are these going to be temporary differences? One thing about the income taxes is that you're generally going to be hiring someone to assist you in preparing the tax provision. And this is really due to the complexity of how we go through and do that provision, because we're kind of reconciling tax and book income. And in terms of preparing the provision, you have to remember is that if you are an auditor, you cannot be preparing the books for the client, right? That's a completely separate business model. Therefore, you have to hire a firm that is completely separate from the auditor to kind of go through and do that work. In Orange County, there is a firm called Wines that does a really good job of doing this. They do not audit any publicly traded companies, at least to my knowledge, meaning that they're not registered with the PCAOB. And because of this, they can essentially, for a publicly traded company, they can prepare the tax provision. So this also might be prepared internally, but generally what I've seen, and again, it's going to be prepared by an outside party. So permanent differences, thank you, artificial intelligence. These are very different than something like book and tax depreciation, which is really ultimately going to be what we call a timing difference. A permanent difference is a permanent difference, meaning that, for example, if we deduct fines and penalties on our financial statements, for tax purposes, they may say no way. If we deduct life insurance premiums on our financial statements, and if they're for corporate-owned life insurance policies, where the company is a beneficiary for income tax purposes, they might not allow that. Lobbying and political expenses, again, may be deductible for GAAP. However, they may not be deductible for tax purposes. When it comes to non-taxable revenues, right, if the insurance policy premiums are not deductible, then the proceeds are not taxable. Municipal bond interest generally is going to be non-taxable. And then over here, you get over to statutory adjustments, things like the dividends received deduction. So some examples of permanent differences, we've kind of talked about these just moments ago. I did not go over the excess of percentage depletion over cost depletion, but that would also be a permanent difference. Now, when it comes to the classification of income tax expense, basically you've got to go through and break things down between current and deferred. Now, what I also kind of picked up when I was going through here is that there are going to be additional disclosures that will be required. In December 2023, there was a new FASB being issued. It required the company to disaggregate its income taxes paid and basically paid by federal, state, and foreign taxes, with disaggregation required for significant individual jurisdictions. That's going to be sound like a lot of fun to go through and prepare. But let's kind of take a look at, I always kind of like doing this of just kind of taking a step outside of ourselves and kind of looking at different publicly traded companies. And if I kind of come over here to Meta Platforms, and let's first take a look at their financials. So the first thing when we go to their income statement is what you're going to see is they're going to basically say, look, there's a provision right over here for income taxes of roughly about $25 billion for the year ended December 31st, 2025. However, that doesn't kind of show us the entire story about taxes. What we're also going to have over here is we're going to also have, like, essentially you've got a provision for income taxes. Um, this is obviously what it was and giving you an effective tax rate. And then it talks about assets and liabilities. The deferred tax assets, and we'll talk about that a little bit later, is that this can oftentimes be, auditors get very sensitive about this because you're booking an asset and you got to make sure that you're going to be able, there's got to be a substantial probability, I think it's 50% or more, that you're going to be able to realize it. So over here, cash paid for income taxes was 7.58 billion for the year end. And you kind of look at over here, and then for income taxes, again, I'll put a link to this, and you can kind of go on your own and kind of basically take a look at this. But it's really, we record a valuation allowance to reduce our deferred tax access to the net amount that we believe is more than likely not to be realized. And we consider all available evidence, both positive and negative, including historical levels of income expectations and risk. And just remember, like, a company like Meta Platforms is dealing in many different jurisdictions or in many different countries. So oftentimes they're going to have, like, they will be subject to different jurisdictions. Now, one of the things over here is when you look at that 25 billion, it's basically breaking this down here, which is, well, what's the current income tax expense? And then what is going to be the deferred income tax expense? So even though they show that our provision for income taxes is 25 billion, as far as current amounts, only about 6.7 of that is going to be currently due. And right over here, you see that's the One Big Beautiful Bill Act, enacted in July 2025. We expect to incur corporate alternative minimum tax beginning in 2025. And so you can kind of see that they're basically going out and deferring some of these different parts. But again, there's a lot of disclosures here for you to spend the time on and to kind of take a look at. Again, I will include this link in sharing with you so you can kind of look at this on your own. Okay, so let's go ahead and go to our first example. So we've got XYZ Corporation reported $300,000 of pre-tax financial income for the current year. Included in that income were the following items: $15,000 of life insurance premiums for policies on which the corporation is a beneficiary. Permanent difference: $75,000 of interest income earned on municipal bonds. So let's go ahead and take a look and put this into our sheet. And let me get rid of this part here, right here. Okay. So right over here, so we got XYZ, and the first thing we need to kind of say to ourselves is pre-tax income was $300,000. Okay, so our pre-tax income was 300,000. And right over here, we've got this included. Basically, to get to this, we deducted $15,000, like remember. So we basically deducted 15,000 basically to get to this, right? Because that was a $15,000 life insurance premium for policies on which the company was a beneficiary. But we kind of say to this, no, you can't deduct that. So this is a 15,000. This is an add back. This is a permanent difference. Okay, we're not allowed to make that deduction, right? So this was the life insurance. Now, similarly, we also had interest income, which would have been a $75,000 plus, which would have been over here, which is the interest income on municipal bonds, which again is an example of one of those permanent differences. So coming over here, so if we're this basically the 75,000 was included in the 300,000 of income. So this 75,000 is not going to be taxable, right? Because this was basically added in to get to this 300. This is non-taxable. So our pre-tax income adjusted is going to be right over here at 240,000. So this would basically be our taxable income for XYZ. Then we have a 25% tax rate. So our income tax expense is going to be $60,000. So the way I would go through and do this is I would say 1231 X1. I would say income tax expense 60,000, and then I would have income taxes payable of 60,000. Now remember, this is a very simplistic example, right? But I think it helps us illustrate, right? Essentially like what's kind of happening over here. And this is going to be to record income tax expense. Okay. One other thing I want to kind of do to just kind of see how this kind of to see if we're correct is I want to go to my artificial intelligence application. And this is something that through our California community colleges, they give us to kind of play around with. So hence play lab. So solve this question and let's see what it says. Okay, so life insurance premium, we've got to add that back, which is what we went through and did. And then over here, so we got to our taxable income. And then going through and computing the income tax expense. And then lastly, we've got the journal entry. So this is a very simplistic problem, but hopefully it's going to help us and help you better understand how these go through and work. So in any event, I want to thank you for being with me here today. Please don't forget to like and subscribe. If you have any questions, feel free to either leave a comment below or send me an email to ibc30tocpa@gmail.com. And I look forward to seeing you on future videos. Have a great day.